So these guys never get it wrong, is the argument. Okay, the markets do well. So this was an digression.
Something doesn't make sense because it doesn't have to do with the market. It has to do a good move. How can the market know now how good of a election committee?
So read the Oscars article. How could the market know now? That's a very good question. Okay, it's something. Yeah. Maybe we all have the information. We predict it. But we make errors, and errors are idiosyncratic, individual. So if we just sum up a lot of predictions.
It is only US, or you can do any elections.
All sorts of things.
All sorts of. Go to intrade.com. Check it out. There you see lots of
I
markets.
can't log in.
You can start your own market there if you wish to, by the way. Okay? So the prediction markets are, okay, digression, I don't have time, but okay. Prediction markets are a hot topic. Your question is an important question. How does it work? The New York Times article on Oscars markets, which have got it right every year, apparently. There's a suggestion there that the Oscar results are already known to the members of the Academy of whatever it is. So maybe it's insider trading, which is a good thing. In fact, insider trading is what releases information to markets. That's the argument in favor of insider trading.
Yeah, there's also jail still.
I know, there's an argument, but it's not clear that that's.
If I get the information, I'm definitely.
The sentences for insider trading are based on the profits you made at the expense of uninformed investors. If you didn't make any profits, significant. This guy went to jail for. Anyway, so markets are, let me say, markets are pretty good at predicting stuff outside of stocks and firm performance, etc. I talked about efficient markets and cap and tal. Also, as a practical matter, you take a judgment call and say, I'm going to predict the risk in the shrimp business and come up with new estimates. Okay? People are going to just ask you, who are you? Ask me, who am I?
So what do you base it on?
The market numbers are these are market numbers. Okay? So
How do you know how accurate they are? How do you check the accuracy of the market?
the second cynical defense of using market numbers is that it doesn't really, the market might get it wrong, but it's the market's number. You're not going out on a limb. It's a collective wisdom of people who are putting their money where they're right. Okay. Yeah. So, but the first is there is good evidence that these prediction markets on US presidential elections has never called the state wrong. The day before the election, the state it called is the state that whatever candidate it called. The state, like state by state, each state, at the state level it doesn't make a mistake.
So you're saying that, for example, if Florida chose Obama the day before chose this, so it's going to be...
It's a good predictor of what are the probabilities according to, yeah? So the New York Times article on markets is a good one, because when people are asked what film will win the Oscars, they say American Sniper. Because they like that.
Seen it. Anyone see it?
No, I haven't seen it.
You saw it?
Too busy with my head in shrimp.
I saw the premiere, so I heard Clint Eastwood speak and I saw that.
You went?
Well, 50 Shades of Grey, wasn't it?
Good.
50 Shades of Grey is not released yet. I know, I'm looking forward to it.
The busy one opening night, midnight show.
I
Yeah.
thought it was released.
All right. Yeah.
It is released.
Okay.
It is?
Yeah.
So it is released.
It came out on Valentine's Day or
Yeah.
it's really Thursday.
Unlike the book, you mean? No.
I read that.
So, all right. So here what I'm doing is I calculated a revenue multiple, like you guys did. You calculated a revenue multiple. I got a big spread in there as well. I calculated, working on top of the income statement, an EBITDA multiple. It was closer, but still an operating income multiple, so after depreciation. And then a market to book multiple. I had book value of assets for these guys. I had market value of assets for these guys. I calculated a market to book multiple. Okay? And that was also unstable. This one was the most stable. Okay? But since I'm obsessive compulsive, I did all 4. So 46 was my term.
You did with that.
Yeah. So I did 46 for this, and all the multiples gave me numbers all over the place for enterprise value. Okay? So then I calculated NPV using that that's positive, the others are negative. If I add up the NPVs from different, if I average the NPVs I get from all these different approaches, okay, it's pretty much zero in this case. So, which means if I have to go and face Mr. Harris,
I discount of 20%, right?
all discounted at 20%.
So then
Okay.
you do it.
So it seems to be a borderline project. My numbers are not converging. Okay, I'm not getting the bottom line. Should I invest or not? It's not converging. Okay, so it's a borderline project. Okay, need to check which multiples are stable across the comparables. There's a footnote in the case somewhere which says Treasure Island's market to book is less than 1. It's getting hammered by the market. There was an acquisition in 1979. There's a footnote in the case somewhere, distinctly remember from a long time ago. So there's the risk issues, which Tal points out. So we are using comparables, the numbers are not converging. So maybe we have to do your own scenario sensitivity analysis. What if global warming kills the shrimp population, etc.? How much do my
What if
predictions
something,
change?
what if, you know what, even better, what if someone comes up with like a new health research proving that it's so unhealthy and this is
Right.
so now what happens? What do
This
you
is
do?
right. This is right.
So we all give up.
So that's going to have an effect on that's going to have an effect on sales.
On everything.
So you want to do sensitivity to sales?
I was gonna give up Chrome.
Sensitivity analysis, but
Yeah.
how accurate is that?
How accurate is what?
Sensitivity analysis.
It is a number. It just then you compare it with your hunch. If you see that the project turns negative NPV, and when sales fall by 5%, this is cause for concern because you think that shrimps give you cholesterol, and it's not. Cholesterol is not a good thing. That the doctors say cholesterol is actually good for you. Nobody really knows. So if it's 5%, then it's a cause for concern. If sales need to fall by 50% for your NPV to turn negative, then it's not too sensitive to sales.
Like, so 5% yes, but 50 not?
Yeah, it depends on standard deviation. You know a little bit of stats, right?
Yeah, well.
So
yeah.
things are normally distributed. 3 times standard deviation is 95% of the, right? So if you need it to be 5 times standard deviation fall in sales, then that's very unlikely to happen because things are more or less normally distributed. That's something called the central limit theorem, right? So that's why I'm saying 5%, 20%. It's really going to depend on the standard deviation in sales, the historic volatility in sales. You calculate that, sales are going to remain within that, okay? If there's a 5-time fall in sales, okay, 5 standard deviations, then that's unlikely to happen. So you could go to bed not feeling, right? Of course, catastrophic innovations. By innovation, I mean changes.
New research.
Yeah. Is the risk. That kind of risk, or the market's best estimate of that kind of risk, is in the discount rate. Okay? So,
And the discount rate?
the future is uncertain. Okay, we have to live with it. It will completely immobilize us if you think about how uncertain the future is. If you truly think of the risk of getting into the elevator at the end of this class,
And then getting stuck.
that's right. So, or something happening. Yeah, my friend and I are writing a book for years now. It's a big book. It's called The Alarmist's Handbook. We're writing. No doubt. It's a handbook we're writing. It's called The Alarmist's Handbook. Right. So, for instance, in the Brookhaven National Lab, which is a few miles from here, they're running an experiment which there's a small but positive chance of creating a black hole. Okay, so when that happens, we're all dying. So I can aggregate that chance over the next 10 years.
Is that before the age of 2000?
No, no. Before the year 2000?
We're all dying in the age of 2000 also.
No, that was
that-
2012.
20.
It's a Mayan calendar.
That's the Mayan calendar.
That's 2012.
Right. So, yeah. So, I wanted to go back and think about these. So I want you to think about the pro forma statements. Try to see if it makes sense. If it makes sense, what I'm doing. You might choose different approaches, different multiples, get different numbers, but if it makes sense. What? Sorry? Okay, so basically just work with the forecaster here, Harris Insider, their numbers, their accountants have come out with Exhibit 7, the numbers. Use my slide 25 formulas, use the stuff I said here to find free cash flows, use valuation by comparables to find the multiple, and then a terminal value, find NPV. This is what I wanted to do, okay? The topic of this course, to put it really crudely, is to figure out where this 20% comes from and what it means. What kind of return, equity, debt, tax effects of interest, debt financing, other costs of debt financing, where that discount rate comes from. That's putting it.
So it doesn't have to be that comprehensive, it's just, you have to be.
That comprehensive.
Yeah.
But
It's pretty comprehensive.
you know, I did every method, every potential case team can think of from the case.
Right.
Okay, but I didn't think of one, which is market, using the comparables to find and give a market share assumption. So I just wanted to do that and send me a short report, like 2 pages or something. One exhibit with the free cash flows, a couple of lines on how you found the terminal value and NPV, some caveats and
In PowerPoint or
in whatever you wish. Okay, Google Docs is fine. Okay, so because I want to share this ground because we want to be in the same place. Okay, this is NPV. This is an internal basic NPV, but realistic. A lot of information.
and this is chapter 6.
Chapter 6 in the book. I like to pretend that those 2 topics, slides 1.1 and 1.2, contains all that you need to know to solve this case. Okay. Okay. So just look at you're on the right track if the 1983 things are looking bad, negative. Look at 1984 is the turnaround year. Once you do the numbers, okay. I like your multiple approach sales, that's fine. Variable, try some other multiples, but that's the terminal value. You need to discount that back. Okay, NPV without, like I did here. And always putting some multiple number here. These are the free cash flows I estimated. Using slide 25 formula. This is the terminal value I estimated using some multiple and comparables. I discount this, everything. Okay?
You divided by 20, and then
1 plus 20, so this is
1 plus 20 to
minus
the power.
1 plus 20, 1.2 to the power 0, which is nothing, 1.2, 1.2 squared, 1.2 cubed, 1.2, etc. And this plus last 1.2, whatever it is. So these are the NPV numbers. You can use the Excel NPV calculator. You can put the terminal value of free cash flow if you wish to. You did a stats course with Shoot, right?
A little bit.
Stats,
It was also very like condensed.
Yeah. So it's, these are the cash flows. So just think of, you have done NPV. Okay. Where is my exercise? I don't have a...
Not there, this is like the first couple of weeks.
I know, that's an NPV calculation. Oh. See, just every year's cash flow discounted back to year 0, 1 plus R to the power t, just like I did in our class. Okay, so those are the relevant. These numbers you will find using my formulas on slide 24 and Exhibit 7. Exhibit 7 forecasts this first row of these numbers, free cash flows. So then
Yeah.
Exhibit 7 and formulas on slide 25, the information on Exhibit 7 will give you this. Okay? And the
Wait,
terminal...
you have to find free cash flow, so this was given.
No, free cash flows were not given.
Yeah. So what was given?
Exhibit 7 net income was given, sales costs,
Yeah,
the
yeah,
ingredients
that's
were
how it
given.
sounded. Yeah.
The ingredients were given. So just need to add those things up. Ingredients for free cash flow were given. This was not given anywhere in the case. So this is the growth estimate. Here is a book value based estimate. Here is operating income multiple based estimate. I don't care which one you use, but as an advice, you see that I calculated all of them. EBITDA, before depreciation, sales minus cost. After depreciation, sales minus cost minus depreciation. I use market to book, comparable book value, market value. I used sales like you did. And I looked at all those and this was the closest. So, okay, but, and then I discount that. So this is an additional cash flow in year 1986.
What do you mean it was the closest? Between all three of them?
The spread between the two.
Between the two, I mean, yeah.
So what's the underlying intuitive idea? That if the comparable is really comparable, their multiple should be also comparable. One guy is a multiple of $4, the other is a multiple of 200. That means they're very different. The market thinks they're very different. So you pointed this out yourself in your
It
presentation.
was quite fun.
Separate, right. So these are quite separate revenue. It looks like treasure seems to have higher costs from the market's perspective. So these were the most stable across comparables. If I find hypothetical perfect comparable, then the multiple should be exactly the same. But in the real world, there are differences. Comparables are not perfect, but these are close. So I use these. All right. So that's a. What is this number? Terminal value. That's the terminal value. That's an estimate of if I sell the firm, if current multiples persist into the future. If I sell the firm in 1986, based on its comparable multiples today, that's the price I expect to receive. Based on operating income in this number. Okay? This is the price I expect to receive based on revenues, I believe. This is the price based on EBITDA, and this is the price based on market to book ratios. They're quite spread. Okay? So using my forecasted sales and their sales average revenue multiple, okay, I multiply my forecasted sales in 1986 by the average sales multiple 0.33, which is the same number as you got.
Yeah, we had 0.37 or something.
Yeah, we have close.
Very
Yeah, I think so that
Probably
number.
because, yeah.
Yeah. So 0.37 times this forecasted Exhibit 7 1986 sales is your estimate. That what's the underlying assumption? That the market has a sort of roughly a fixed ratio of valuing your firm given your sales. Sales is the main driver of growth. Your estimate of that multiple is 0.37 in your case. You have a forecasted sales in 86. Multiply the statistic by your forecasted sales to get a market value estimate. So same for this, same for this, same for this. This is the most commonly used multiple, EBITDA, in this kind of valuation. Okay, enterprise valuation. Okay. You have information on all of these. Okay. Compare them. So, the point is not to get the right answer. There is no right answer. The point is to think through what you're doing. Okay. What makes sense, etc. I'm out of time. Thank you so much for this. Okay, so if you write down a couple of pages, showing us the key exhibits. If they say Exhibit 7, etc. Now I know you worked on the case, you've seen what I've done, then I'll post it next week. You email it to me anytime between now and next Sunday. Okay, I'm just saying this to help you. Okay, this is not like this is not an undergraduate class of grades and stuff. It's the effort that matters. Okay.